Jackie's still there. And again, Jackie, just put all your concerns or questions on the messenger, and Nicole will handle that for us. And guys, feel free to kind of jump in. Mickey, I know you're there, because we want it. I think the only way you're really going to get a lot of it, especially because it's a small group, is to really ask the questions, right? So we are, for the love of real estate, we are the Borerro lending team at Cardinal Financial. Sasha couldn't be there with you guys in person today because she's got something going on with her health. Not too serious, so that. So basically what I want to kind of highlight here is about mortgage myth, right? I'm all about mortgage lending reimagined, because there's so many, anyone can do a mortgage, you know, but there's so many different caveats to mortgages these days. And, you know, everything is ever evolving, and we're always pivoting as well on new guidelines or adhering to the demands of the market. So what we wanted to talk to you about today is just home buying myths per se. What are the facts? What are the myths? And there's always going to be in between, right? There's always going to be some gray areas. So with caution, we will proceed, but there are always going to be gray areas, guys. So this is, so again, who we are partners with Keller Williams Princeton, very fortunate enough to be partners with you guys, but we are also partners with the other Keller Williams market centers, and we have been involved with Keller Williams for a little over 15 years now. So it's just jumping straight to the home buying myth. This is what we're going to cover. We can spend as much time in the various different sections, but I want to cover home buying myths when it comes to credit, appraisals, loan products, and closing costs. And then we also have the Q&A, but guess what? We can just do the Q&A as we go along. So what I want to cover first is, and this is something I just rustled up this morning, so it may not all be there, but we can discuss them. So when it comes to some of the myths, right, with credit, some companies that you deal with, and again, it may not just be myths, it could all just be facts that we're dealing with. Credit reports are normally good from 9 to up to, depending on the company you're with, but typically standard is 90 to 120 days. However, when you are dealing with a broker, they may be pulling credit a couple of days before settlement. And what happens, the dangers to that is when they're doing that, they could be lowering the score, and now 2 days before closing, you're not able to go to settlement. Or it could well be that the borrower during the process has used their credit cards rather than the cash that they have in the bank. And now when a broker repulls credit, that can also, number one, may not necessarily bring the score down, but the monthly liabilities may have changed to where the borrower no longer qualifies. So when I hear that a lot with some of the deals that we take on and do rescues for, we call them 911s, we don't have that. Okay, our credit reports are good from 90 to 120 days. We are not repulling credit a couple days or the day of settlement, so you don't have to worry about that with us. But just beware with other brokers that sometimes you have no control of utilizing because they were referred by, you know, whatever referral source you had, or the buyer insisted, whatever the case may be. But this is what I see. These are the facts that I just provided, and you don't want to be in danger of doing that for the various different reasons. When it comes to collections account, right, there's such a huge myth out there that the buyers think that because they have a collection, they're going crazy trying to pay this collection account down. No, 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 no. In many cases, in a vast majority of cases, collections account do not have to be paid off, depending on how they are described on the credit report. Most often than not, if there's a collection account there, paying it off will not necessarily bring your scores up. That's a big misconception. So again, get them to the lenders, get them to us, so we can determine if that collection needs to be paid off. And typically we will say no, again, depending on how it's coded on the credit report. Many times, if they do have a large collection that exceeds $2,000, depending on how it's coded, we will not require them to pay the collection off. What we will do is take 5% of that debt. So let's say, for instance, if they have a debt there for $10,000, we will just take 5% of that and put it as a liability, and then qualify them to make sure, that they qualify with that debt, and then they no longer have to pay that collection off. So again, depending on how it's coded, but there's a lot of myth. Everybody's trying to pay this off. And what happens is they pay it off for all kinds of reasons to get their score up, and it really didn't change anything. And now they're out $5,000, $10,000, whatever that amount is that could have helped them purchase their home. So again, we have to watch out for that. There's a lot of misconceptions and myths and everything else that surrounds that. When it comes to credit monitoring, a lot of the buyers, especially now, I've seen it more and more now, that buyers are utilizing the online credit reporting system. And that is great, right? To keep a track on a day-to-day, weekly, monthly. And obviously someone that tracks their credit like that, they want to eventually get to a good place, right? Or they're just tracking it for security purposes, prevention of theft and things like that. However, understand this, right? And I've had very difficult conversations with buyers about this. I have seen where they have showed me Credit Karma, or what other services are out there. There's a bunch of services out there. Credit Karma just springs to mind, where they have, let's say, a 680 credit score. But in actuality, the different algorithms and the different scoring systems that those Credit Karma's online services utilizes are not being utilized by mortgage companies, right? So they could have a 680 credit score, but in actuality, when the mortgage company pulls that credit, it could be a 6, as low as this. Actually, it could be as low as in the 580s, but typically it's not that drastic. I've seen a 70-point cushion. So, you could have 680 Credit Karma. When the credit bureau, when we pull it as a mortgage company, it could be a 620. So understand. So, when we have those conversations with borrowers, we kind of go into more great depth with them to let them know that you're getting a consumer report, right? And, and the Isaac reporting agencies, this is what they give you, but mortgages are ran through a different algorithm. And typically with those credit monitoring services, you're not getting all three bureaus. The three bureaus are Equifax, Experian, and TransUnion. Sometimes they're only getting TransUnion, and then, you're not getting the other two. So really, you're not really knowing what you do, because the other two could be lower, the other two could be higher. So again, with those myths, they are a myth, because they're not really there to, they're there based on the consumer platform, not the lending platform, if you will, if that makes sense. So, but we can have those conversations. We see all the time, but just, on a standpoint, I want the agents to kind of know that, and then redirect them to us so that we can have that conversation. Appraisals, right? So now, as we go into the market, Anita's coming on. Should I continue? She's just doing audio. As we enter into a market where we are leveling out, right? Everybody has different terminologies for them. I actually say that we are correcting ourselves and we are leveling out. And what you're going to now see more of, you're not going to see a lot of the inflated values on appraisals, right? So how do we get ahead of that? So like back in the day, in the last couple of years, the price has been absolutely crazy. As we go into this market where it's leveling out, there's going to be some things that you guys need to be aware of and pull the resources of the partnership that we have with your market center of how we navigate through this. So it is a myth, okay? Well, again, I got to exercise caution here. When you're working with an FHA buyer and you get an FHA appraisal, all right, if that FHA appraisal let's say comes in at not a favorable value, it comes in lower, right? What happens is, and then the sellers and the buyers don't come to the meeting of the minds to get to that value. Number one, if it is a myth that that I'm going to be very careful that value stays with that property for 6 months. It really does stay there for 6 months. However, all right, you can rebuttal that appraisal value and do a reconsideration of value. That reconsideration of value would consist of the agents, both sides, supplying PDF comparables that are not currently used already. You guys know all that. But what I'm speaking about is that if, let's say, that deal falls apart, right? And then you have a new FHA buyer. Let me tell you something. No one's going to tell me that I can't get a new appraisal because that appraisal it has to stay with that property for 6 months. There's some truth to that. But if you're dealing with a mortgage company that understands how to pivot around and is knowledgeable about FHA, I'm going to tell you right now, I will get another buyer. I will get the FHA case number transferred to me, and I will get my new appraisal. Because sometimes if there's only a $5,000 difference and the original deal falls apart, when you get a new buyer involved, and let's say I was the lender, I will know how to navigate around that. And sometimes there's appraisers out there that it's only, $3,000 or $4,000 difference. They're going to make that thing work. I will not have to use the FHA appraisal on the original. Does that make, you guys have come across that, right? Okay, Mickey, go ahead.
So if you have the reverse case where the original transaction that fell through had a higher appraised value.
Okay.
The market is shifting. We're 2 months down the road. We're within that 6 month period. We can use that original case number to maintain that higher value, correct?
Correct. The appraisal is good for 120 days.
Okay.
So you absolutely can. The thing is that you have to make sure that the lender that you're dealing with knows how to, they should do, right? We all do.
Well, some don't understand that process.
Yeah, so the process is really requesting the FHA case number alongside the FHA appraisal and the, there's all, and the XML format and the independent cert and all that. And that's very normal. So they should be able to do that. So yes, but in the event that it's the reverse that we talked about, and you don't have to. I won't even need that appraisal at all. I'll just order a new one. Okay. So now I'm going to move on to VA as well. And again, it's all to do with what's going on in the industry right now. If you are dealing with LAPT approved underwriters for VA, I am never concerned about a value. I'm going to make a bold statement. I am never concerned about a value on a VA appraisal. Obviously, if there's repairs and all, that's a different ball game. I'm never concerned about the value. I'm going to tell you why I'm not concerned about a value of the appraisal, VA appraisal, is that last year I'm going to give you real life situations, and it happened in Keller Williams offices. Last year, I had 4 VA transactions that appraised low. One of them appraised at $40,000 lower. So no one, the seller was like, no, I'm leaving it. I'll get another buyer. So what ended up happening was this particular one, the one with the $40,000 difference, the buyer wanted it, period. His statement was, I went under contract for this amount. It was like 240, actually, something like that. I went under contract. And I do not want to lose the house because of what's going on in the market. He was a little bit more educated, this military guy. So for him to purchase that home, he was in agreements that he wanted to stay with the higher price, but the seller didn't want to come down. So normally, if that happens, normally the deal's dead. Deal's dead because mortgage companies cannot fund a loan that the value is not there, right? There's ways to navigate around that, guys. I have my connections directly with our VA office, which is in Cleveland, Ohio, and providing that the borrower advises us in writing that he wants to proceed. And there's other things that goes on behind the scenes. We can close that deal. Because the VA themselves will check, see that appraisal, if the contract price is 240, that comes in at 200. Once I present whatever I have to do behind the scenes to Cleveland, directly with Cleveland, Ohio, they will come back and they will override that VA appraisal and put an approval there for 240. So again, a lot of things, right? There's a lot of myths that it's not, none of these deals have to be dead. And I know that I've taken a lot of deals with appraisal issues like this. If your loan officer doesn't know how to navigate around certain things because they're not as knowledgeable when it comes to difficult and challenging situations, that could fall apart, but more power to our team because we're able to 911 and rescue that deal. So that's that with the VA. The other thing that I wanted to touch on real quick, a lot of people think, oh, let's just put them conventional. Let's put the buyer on a conventional mortgage because it's easy. And if it's as is, guys, that is such a myth. I don't care if it's a conventional appraisal. I don't care if they're putting 50% down. If there's problems with the property, it's going to be noted and repairs are going to get called for. Now, obviously, it has to be something pretty in depth. Like they're not going to call for peeling paint. Conventional financing doesn't care about peeling paint. But if it was something like it's not a functioning like the heater or something like that, or there's a wall that's been knocked down, but you can just do it it will get called. Don't believe that just because it's conventional finance, let's push our buyers to conventional financing because it will easily pass it. That is a myth. 100% a myth. They're a little bit lenient, but they're not going to turn the appraisers are not going to risk not making commentary with reference to anything like that. So back to my last piece on the appraisal piece about reconsideration of value. The thing is, here's the thing, a lot of I don't know if it's loan officers, let's just call them loan officers, right? Don't understand how to present a reconsideration of value. So basically with the reconsideration value, you guys have to just give us 3 PDF of recent sales and provide us narrative, right? And an example of that is this, actually my own personal home. My home did not appraise. My purchase price was XYZ. And when the appraisal came back, it was considerably lower to the tune of almost $100,000, right? So I kind of expected it, but I didn't expect it that low. But here's the thing, guys, we were not able to produce the comps, but we were able to do a narrative on it. And it was a 1-page narrative. And the narrative consisted of, this is a 20-year-old neighborhood that if you look back in history, nothing has sold because it's so well sought out neighborhood that no one goes anywhere. So that kind of thing. And then you can pull up the comps of how much all these houses were built back then and still in superior quality versus there's so much thing. And again, it really takes the person, the mortgage company or the person that you're dealing with to extract those information from you as the agent and be able to write that narrative up. And, you know, so many different things that can come into it, just the neighborhood, you can compare it with other neighborhoods, even if they're 10 miles or 20 miles away, but a comparative and make those narratives. So again, you know, those situations, you know, a lot of loan officers and mortgage companies don't care. They were like, not that they don't care. Let me not say that. They just don't know how to work it to kind of keep it back in. So again, the only way I can fight something like that is I've got to extract a lot of information from you guys. As long as you know the neighborhood, then I can translate that back and get that handled. All right. Loan products. Let's skip on to the loan products, the myths.
Yeah, real quick.
Go ahead. I'm sorry, Mickey. Go ahead.
That's okay. I want to on the appraisals. I had an appraisal last week, and the appraiser was saying that they count the square footage different for an FHA loan than a conventional. Like in a Cape Cod, depending on the ceiling height on the second floor will depend on whether they count the square footage or don't count. So
Right.
we could be looking at that we think is 2,200 square feet. They may only be counting 1,100.
Yeah, but it's because of living space, right? It's
Yeah,
gross
I don't know if
living
you
area.
have
It's the GLA. I'm sorry.
Do you have any guidelines on that you can share with us, or where to look?
Well, what I can do, here's the thing, right? Because I'm not an appraisal expert, I just know through experience. A lot of the times, if it's not like with Cape Cods, if I'm not mistaken, isn't it? They just have like a little space upstairs, and it's not necessarily counted as a living room or bedroom, right?
I think he said if it was less than 7 feet in height, that they didn't count the second floor, even though it could have two bedrooms and a bathroom.
Yeah, I've actually encountered that. But here's the thing too. If even though it's you had, like you said, those parameters of the 7 foot in height, right? If there is a legal living room and a legal bedroom with a closet, and that description is with the county, oh, you've got to count it. That's gross living area. You know, but what I'd like to do, maybe we could do it for our next one, or, you know, I actually have an appraisal friend of mine that's great at doing this, and he can come in at one of the sales meetings, just do like a 15-minute blog for you guys, so he can share with you and you can have all those instances. Maybe I could do that, because I don't want to kind of speak on behalf of
I didn't know if you had any issues with any of your customers, because they made it sound like FHA and conventional were counting living space differently.
Yeah, no, I haven't had any issues with Cape Cod situations, but like I said, if there is a bedroom up there, right, and it's a legal bedroom, you've got to count it. And if the description meets what's on what the county or the city or whatever, then you got to count it. So what's happening?
Their property records aren't always accurate.
Okay, well, let me do this. Is that deal dead for you?
I know that it didn't impact my property. He brought it up in conversation at the house that he was appraising.
Oh, okay. Well,
I said that's different. I've never heard of that.
Oh, yeah, I've never heard of that.
Being that Jackie and I are on here, we both have over 30 years in the business. And I don't know if Jackie's heard anything to the contrary, but you know, that could change the ballgame depending on who comes there if they don't have adequate knowledge to know to contest that.
Right. So here's the thing, right? It's hard for me to cast a huge net, but right. if anyone on this call has a situation where it's going to be and the appraisal has been performed and you see anything like that, guys, even though I'm not involved in the transaction, right? Let me take a look at that, or that copy of that appraisal, because I will take that appraisal and send it two of my two appraisers, and they will give me a valuation of that. And then if I have the narrative to support that that's incorrect, I'll give it back to you with that narrative, so you can go back to your loan officer and be educatedly armed with the information, so that that deal doesn't fall apart. You know
Right,
what I
'cause
mean?
I have the listing, so knowledge is power.
Right, exactly. So, if you have the listing, will it affect, I guess it's going to affect your listing price. If you want, you can have the seller do an appraisal.
Right.
I would do that, and I would have somebody, that like I have a couple.
No, absolutely. It just,
Yeah.
if you have a multiple bid situation, and FHA counts it one way, conventional counts it another,
No.
and almost identical, then, that's where, if there was a
That's where
guideline.
you're gonna, no, I don't, that's it again. If it's legally a bedroom, in the township, and it's legal, you have to count that. That's still gross living area.
Right, again.
And I would actually stick my nose in and actually say that. So I don't know what they're saying.
It caught me off guard, and since you were here, I figured I would ask.
Well,
you.
yeah, well, the thing is, right, you're in the real estate and I'm in the mortgage end, and it's both not making sense to us.
Correct.
So, I would say that that's still questionable. So if you have the listing and if you have a problem, even if I'm not part of the transaction,
Right.
Nikki, reach out to me, because we're not gonna fall
Absolutely.
over that. Okay.
Thank you.
No, you're welcome. Now moving on to loan products. Again, especially, right, are not necessarily our seasoned agents, right? But especially the new agents that are breaking into our industry. People are thinking that you need 20% down. We all know, or for the most part, that is so not true. That is so not true. I mean, you have conventional, and then when they think, okay, not 20% down for conventional, 5% down. Not true. With conventional financing, you can go as low as 3% down. Now, of course, we have all kinds of products, right? Such as the VA, the USDAs, and the DPA. DPA stands for down payment assistance programs. They're all 0% down loans, and they're good ones too, So again, a lot of misconceptions about down payment and things like that. The other thing is also with respect to down payments and stuff, it really depends, because we can go as low as a 550 credit score on FHA. However, that 550 credit score, you're not going to get away with 3.5% down. You're going to put 10% down on that. So again, with loan products, I mean, we can go on and on about different scenarios, but just typically, don't listen to your general of what you hear generally out there, because there's so many. As we evolve, and we always find new products, new niches, so it's worth the phone call. It's worth going over, and this is why these trainings are good, right? So we can give you more information, and we will do our best to get information out there to you guys, whether we're there in person at your sales meetings, or we do like just special trainings or whatever. But I would say every 3 or so months, there's always a new product coming in, piggybacking off FHA, piggybacking of conventional, just to be more creative, so that we can continue to ignite the current market, because that's what the government wants, right? That's why a lot of these products are coming back, loosening up, because we want to make sure, like during COVID, obviously the rates went down crazy, and now that we're leveling out with values, etc., the interest rates aren't really going up. They're supposed to be, if anything, they should be higher than what they are currently. So what we do on the mortgage end, with the government, is that we try and develop other products to piggyback off existing, to accommodate the current market. Just like, for instance, when the interest rate rose to 7%, oh my God, everybody was like, we can't afford to buy. Well, guess what? We rolled out the 3, 2, and 1 buy downs. And for those of you on the call that don't know what the buy downs are, basically, if right now, which is not, because it actually lowered, the interest rate lowered earlier on this morning, if the interest rate was 7%, where everybody was so used to 3%, what will happen is on a 3 and 1 buy down, the first year your interest rate would be 4%. The second year, your interest rate would be 5%. And on the third year, it would be 6%. And then after the third year, you will go back and resume to 7%. But what that 3 and 1 buy down gave to the consumers, not just lowering the interest rate so that we can encourage the sales, right? But what they did is it's given you time to where, the buyers have an opportunity in the future, whether it be 6 months or a year from now, to actually refinance to a lower rate once everything stabilizes. So again, products are going to be out there, and they're going to, the demands of what's going on with the economic climate. Most mortgage companies that are in retail, and we are part of the retail division, we're always creating some outlets to accommodate and ease the pain of whatever's going on currently, so that the real estate agents continue to do business and we continue to do mortgages. Does that make sense? Okay, it does. Closing costs. All right, so current myths with closing costs, which I don't know if you guys ever I've come across it yet. I'm sure you will do. So back in the last couple of years, right, nobody was doing closing costs because everything was selling, right? Well, right now it is a myth, because sellers concessions, I'm seeing it come back with a vengeance, because that's the only way, this is the only way right now, with the buyers now having to pay points or bringing down their interest rate, etc. They need sellers concession. It could be, whatever, up to 6% sellers concession, so that they can accommodate all those buy downs, or cover most of the closing costs, so they can put larger sums of money down. So that is the mindset now. Everybody's being creative on how to be able to put a deal together, and that's all it is, right? Now we're in it right now, and the only way to get through this as agents and mortgage partners is to be so much more creative than we ever were before in putting deals together. And a large chunk of it is going to be money, right? So definitely sellers concessions are coming back in full force, and I'm seeing them, and it's okay, right? And I think once we educate our sellers as listing agents that these are the things that that will be coming to the surface, there's no really a lot of objections. And even if we don't handle that on the listing and upfront, through the transaction, we can still educate the buyer's agents and whatever the case may be. But it's a myth now. We are giving them out left, right, and center. Obviously, people forget sometimes that part of some of your closing costs, especially now, are tax deductible, and especially points. People are paying points, etc. So that's an advantage. But again, seek your account expert or CPA regarding that. I mean, I'm actually an accountant, but I will not speak to that because that's not where I have my license right now. But yes, definitely tax advantages with that, and I think a lot of people forget. But the thing is, right, it's the time of year, right, where it's tax season. I think, to try and other marketing tools for you guys is that whoever you closed last year, whether it be buyer or seller, you know, send them a copy of their altar, get together with your title partner if you don't already have it on a Google Drive or in your files. You know, that's one more way to communicate and touch previous clients, so you're now top of mind with your card and ask for that referral. So just little things like that. I mean, is anyone doing that? Or have plans of doing that, you know, this within the next couple of months? Because you should reach out to your clients and send them, put it in an envelope, put your card in there, and then that opens up some more opportunities, God willing. And with that, that's really all I had to talk about. But if you have any, was there any questions on the chat or anything? Did someone want to speak up? Listen, we're such a small group that you know, whatever you have, let me answer them for you. Did I speak too fast? Because I have a tendency. You're muted. I can't hear you.
Hear me now?
Oh yeah, now I can.
I didn't think you talked too fast, but I'm a very fast talker.
Yeah, it was, I tried to. So I wasn't, was that some of it good information for you guys to take away with you? Most importantly, guys, you know, we don't need to have you know, an arena like this. Please feel free to reach out to us. There's our contact information, and we'll be bringing more pens, notepads, and all that good stuff to your office so that you can pick up. But, you know, if there's a situation that you're having, and even if we're not part of it, but you kind of think that you're not sure, guys, reach out to us. I take no offense to that, because listen, you know, we're supposed to just stand. We are here to support you, whether we're part of that transaction or not. And then what happens is we're going to build that level of trust, right? Pick up the phone. We want to guide you through and close that transaction whether we're part of it or not. Okay? So please feel free. I mean, that's all I had for you, unless anybody else had anything.
Thank you so much, Kat.